Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's been going on in investment markets and what to look out for in the days and weeks ahead. Now, if you recall last week's show, I talked about the Federal Reserve meeting and the tech earnings. Now, in particular, the tech earnings we had last week. If you recall, we had Facebook, Amazon, Apple and Google all announcing their results on the same evening. And that set up quite a big moment for markets, particularly in terms of the direction they could take over the short term during the summer. And if you recall, tech has been it's been doing really well. Tech stocks have been flying. They've been largely driving the market, but then they've taken a bit of a respite, a bit of a backseat to some of the cyclical sectors. And they were testing a line of support. If you recall on the NASDAQ 100, I told you last week to grab out your phones, look at the NASDAQ 100 and see the line of the index moving up and the support line, the imaginary support line that would be there going up in a straight diagonal line that it's been bouncing along. In fact, I'll actually link to this in the show notes and you can see a live version of that chart. And what happened is the results came out in the evening and they blew the doors off. So for Facebook, Amazon and Apple in particular, they were extremely positive, and Google's results were pretty good too. But it meant the tech stocks rallied in the after hours trading. We saw some of the share prices jump 5, 6, 7%. And in fact, in the next day's trading, Apple shares were up as much as 10%. So it meant that the technology stocks and the NASDAQ 100 in particular just took off to the upside. So the tech trade, the buy US technology stocks trade, which is quite crowded at the moment, again started to really pay off. And what it meant is it pushed the market higher in America. So the S&P 500, the technology stocks, as I've been telling you during these podcasts and videos, have been driving the performance of the S&P 500 over the year to date because they make up such a sizable portion of the index. So that pushed higher. And in fact, as the week has gone on, we've now got to the point that the S&P 500 has broken above 3,300, which puts the all-time high in February, which is up around 3,400, within touching distance. And it means we've temporarily at least broken out of that box that we seem to be in between 3,250 and down towards 3,000 on the S&P 500. So you can imagine the euphoria around the world when US stocks pushed higher, when those technology stocks pushed higher. And we saw the fear index in America, the VIX, drop down to below its 200-day moving average once again. So if you couple that with a US Federal Reserve meeting that went largely without incident, although the market after that particular meeting did pull back a bit because we had some dire economic numbers out of the US. We had one of the worst quarters on record, but that was in some way to be expected. But it just emphasizes that stock markets are pushing higher, yet the economic fundamentals are still worrying when you look at them. And so we could still have a day of reckoning at some point in the future. But technology stocks, as I say, are still flying. Gold is still flying. Interestingly, the gold price has now pushed above the $2,000 an ounce level and actually closed quite aggressively above that. So we could see even more strength in the price of gold, despite the fact it again looks overstretched. Silver is doing very well as well. Now, if you go over to the UK, while there was some euphoria around equity markets after the technology stocks results, in the UK in particular, that was quite short-lived. And in fact, the FTSE 100 dipped back below that key 6,000 level at one point this week. And it put it back down 20% below its year-to-date highs, which would technically put it still in a bear market. So UK stocks are being left a long way behind. And in fact, if you've got your phone and you look at the charts, look at the price moves on the S&P 500, see if you can find an emerging market index, maybe Chinese equities, have a look at Japanese equities and even European equities as well, and compare them to what's going on in the FTSE 100. And one of the trends you will see is emerging market equities have done particularly well this year. And of course, US equities have done so too. Then you've got Japanese equities sort of lagging in sort of the third, fourth of that list I just gave you. in negative territory still, then European equities, and then, of course, UK equities. Now, if you combine what I've been talking about, gold's been doing well, so commodities generally have been doing very well, US equities have been doing well, the FTSE 100 hasn't. The Japanese equity market has just taken a turn for the worse in the last week or two. And a lot of what's driving it is the US dollar. So the US dollar is in a period of sustained weakness. If you look at the US dollar index, so Google Bloomberg dollar index, you will see an index, a number for the dollar index, which is around about 93 the last time I checked. Now, this gives you a broad measure of the strength of the US dollar against a broad basket of other currencies. Now, when the dollar is weak, it has a impact on a lot of other assets. So it's normally positive for commodities, as I've mentioned before. So that's why gold is also pushing higher. It can also be good for certain US equities up to a point, particularly technology stocks, because a lot of them make money overseas. So when you get that currency exchange, it makes their overseas earnings more attractive to US investors, which pushes up their share prices. On the other hand, the FTSE 100, we see the opposite impact. So the dollar pound exchange rate has actually now pushed even higher above $1.30 to about $1.31. And we've seen that continue to push higher. And the impact for the FTSE, on the FTSE 100 is that when the dollar is weak and the pound is strong, it means that the overseas earnings in dollar terms, when they're repatriated back to the UK, they're less attractive. So it means that the FTSE 100 as an index, because a lot of the companies on there have earnings overseas, the share price generally start to fall for the broad index if you take it as a collective. So that's another reason why there's been downward pressure on the FTSE 100. So you can see that the dollar at the moment is crucial to what's going on in a lot of investment markets. Now, the correlation between the strength of the dollar and the S&P 500 and the gold price, for example, is at extreme highs. Now, you get a measure of correlation statistically. It's measured between -1 and 1. So that means if two objects or two assets have a correlation of 1, when one moves up, then the other will move up in lockstep. There's a perfect correlation. If it's a negative correlation, then what happens when one moves up, then the other moves down. So if it's a -1 correlation, then that correlation coefficient, that number's called, then that means they move in the opposite direction by an equal level. And of course, if it's 0, then they're uncorrelated. What we're seeing is the weakness in the dollar is fueling a rally in the S&P 500 and gold. So there's this negative correlation of almost -1. It's just below it. That's extreme. But what it does mean is, worryingly, that correlation has been getting stronger, that if we suddenly get a reversal of the weakness in the dollar, which has only just taken on its latest accelerated move to the downside since May, if we get a reversal of that trend, you can see it's going to pull the rug from a lot of markets, and it could be negative for the S&P 500. It could be positive for the FTSE 100, but it could be negative for gold. Also, if you look over in Japan, the strength of the yen versus the dollar has a huge impact on the Japanese stock market. So if you look at the Nikkei 225, now that's why you've suddenly seen the Japanese stock market take a turn for the worse in the last 2 weeks. And actually it's been underperforming. It had been doing quite well. Now it's turned to underperforming as that weakness in the dollar has caught up with that particular asset class. So keep an eye on the dollar index in the coming days and weeks, because it is pivotal to what's going on in equity markets. And it's not really getting all the headlines in terms of the importance of its influence. We're focusing a lot on trade wars and, of course, the coronavirus. So why is the dollar so weak? Well, the coronavirus is one of the reasons, because obviously there's the handling of the coronavirus in the US and the impact it could have on the economy. So it's a sign of a lack of confidence. And another reason is, of course, the US Federal Reserve with their money printing. If you print lots of money, then it actually reduces the purchasing power of the currency, in this case the US dollar, so it's pushing it downwards. So keep an eye on the dollar because it's having a huge impact. But to sum up, at the moment, the trade of buying US technology stocks is still performing well, and focusing on government debt in particularly the US and the UK is still doing very well, as is holding gold in your portfolio. Of course, something will eventually change. It's like all these things with particular momentum trades that are going on at the moment. The trend is your friend until it is not. So keep an eye on all of that in the coming months. And don't forget, we've got the US political season kicking off. We've got the US election later this year. So that's going to have an impact and could cause a little bit of uncertainty in markets. So that is it for this week on Damien's Midweek Markets. As ever, you can contact me, Damien at moneytothemasses.com is the email address. Money to the masses with a number 2 is the Twitter handle. We're on Instagram, we're on Facebook. Join our group, facebook.com/groups/money to the masses. And don't forget to subscribe to our YouTube channel.